There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits, or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
If you live in the U.S., you know that the Labor Day weekend is now finished. What upon us is work, school, back to normal activities. The summer's over. Nah, I'm kidding. Not to be a Debbie Downer or anything here, but I've been on vacation, so I think I'm a little rusty as well. But today is the 6th of September, Tuesday. I try to do these meetings a little bit after 1 p.m., albeit technical difficulties today, right? I did not do the cast on Saturday, so if you were looking for that, I was out of town. I'm going to make up for it today. So we come back from vacation, albeit in some cases with dreams of summertime ocean waves like myself, but have to focus on the matter at hand, and that is, how do I prep for a week of trading? Now, even though we probably will have lighter volume this week as at least the wealthiest on this planet get back to work, get off their yachts, all that fun stuff I talk about, typically big moves aren't made in August. Okay, it's really the bottom line. So as we come into the week, I wanted to take a look at the Forex Factory calendar first. You can see the holidays yesterday if you're looking at the screen. Hope everything is coming across okay. Note that today is Tuesday, and on Thursday, ECB press conference and Chairman Powell speaking. So note these two would be trading anywhere around any of this stuff, right? So I would say that the volumes may be lighter this week. Doesn't mean there's going to be heightened risk. We've had a fair amount of movements, and yeah, who knows, maybe somebody would come in, but I just don't see the volume in the markets to really sort of push things around. Do note that the economic data continues to disappoint with some pretty impressive downside surprises in leading and interest rate sensitive sectors like housing especially. I show a lot of the charts of the different housing. I'm actually going to show that on this as well. So if you haven't seen it already, just go to FinViz and it's finviz.com/futures. Click on the daily charts, click on all, and you get the whole dashboard. I like this. See where everything's going, right? So is there inflation? Well, they thought, if you just look at the S&P 500 on the screen here in the center for an example, we thought quantitative easing was going to take a break here, hence the rally, right? And now quantitative easing is about to accelerate. And the friendly, essentially, dynamics behind the Fed balance sheet composition, which helped risk assets stage a comeback rally in this July area I'm pointing at, they're likely to fade away in Q4. We've already not had the best start to the end of Q3, essentially, right? So as Q4 starts, remember that's October, November, December is Q4. It typically is a bullish time for the equity markets. It typically is a rally mode. Doesn't necessarily mean that's going to be the case in commodities and currencies. We have more headwinds than ever, right? So the powers to be, or at least I should say the incumbent powers to be, are going to try and keep things calm. Thus, the election, which is going to be a big one in November, hopefully will have very little tailwinds. But there's already been enough to sort of sink your teeth on and continue chewing. So, nevertheless, we just heard Powell deliver a while back at Jackson Hole. I talked about a very decisive speech where he stressed that the Fed won't be making another mistake. So essentially, after underestimating inflation in 2021 and delaying the tightening cycle, they will not prematurely stop now. On the other hand, they will keep it at until they're confident that the job's done. So getting the job done will come at a great cost for the economy and markets, in my opinion. We've discussed economic data, the impact of quantitative tightening, and how that affects markets, even though it hasn't been as much of a discussion about currencies at this point, because I think there's much more room for education from other market sectors, and quite frankly, I'd rather you guys all have a macro view or discussion on all of this. So I think I find myself more and more trying to speak on a fifth grader level, and that is not to demean our readership or any of our subscribers, but truth be told, most people don't have an interest in this area. And so as much as I can weave it into the fabric of your everyday life and how it may or may not affect risk is going to be hopefully very helpful in understanding, and then that, as all teachers would hope, becomes more engaging for the student, right? Though, bear with me in my sort of strange quest to go through this. This does also help me as it sort of forces analysis upon all the areas, right? So, believe it or not, there's been some good pin action off of these weekly pod, and in some cases, it seems like what's the point Vettel's trying to get in a diatribe, and has it really helped me get a grasp of what's most important is in conveying risk management and structuring client portfolios and trades and all that fun stuff I do for a living. So without that, let's take a look at the markets. So I think we're what, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 10. We're about 20 days into the decline from the S&P. Pretty big one. I was sounding all kinds of horns at the top here, talking about how you really need to get out if you're really heavy in equities, and especially if you need the money for something short term. I would be surprised if we see this top again later this year. So I would expect us to spend a good chunk of the rest of the year working a large balance area, right? Value area highs, lows, center points. I'm not necessarily labeling these on this chart, but just trying to give you a feel for it and how it can play out. So let's go back, take a look at. I'm going to just rip through this real quick. So here's the precious metal space, right? Inflation going up. Just take a look at, these are daily charts, just take a look at each of these areas. It's not really that important. I'm not going to comment on too much of this. Since we're actually looking to build a new house down here at some point when the dust settles, and who knows, maybe the dust is settling in lumber prices. I always have a tendency to focus more on lumber and metal costs of recent. But looking at the dollar, we hit 110 last week. It's been absolutely eons since the dollar was at this level. I mean, eons. I've shown monthly charts and gone all the way back 20 plus years to this. So for those of you out there, and look, I get it, the British economy outside of Russia, for, obviously sanctions and Putin and his oligarchs being buttholes and trying to go after Ukraine, they are going to probably be the worst developed economy country. But I'll tell you, the UK is right behind them, and it's sad. I mean, these guys are looking at inflation in excess of 13% right now. Could get as high as 22. which is the highest it's ever been in the UK. So for those two reasons alone, right, I'm just not a buyer of the pound at this point, right? So we've gone down and down and down and down in the euro, and I just, at some point you hit 2 and 3 standard deviations, you're way out on the Bollinger Bands on this stuff, and yes, there's going to be pullbacks in the dollar just because most of these markets are just so ridiculously oversold, right? That they will be. I mean, look at the yen. I mean, this is just bananas. So I'm not going to bore you guys with going back, 20 years on a lot of these charts. I did that in some of the previous casts that are up on Vimeo and the YouTube channel. You can follow along on them. I did think of note though. It's just looking at a monthly chart of the U.S. dollar. And many didn't think this high watermark of 20 plus years ago is in force, which was a really good double top on a monthly chart. I think this could absolutely be in play. Not saying it's going to rip right there right now, but I mean, these are monthly candles. So as you can see, just from no other analysis, it has been an absolutely protracted move outside of it, right? Let's just call other time frame players buying into the dollar, which is obviously the lesser, not by much, of all the evils out there right now in currency land. So I would expect dollar to go higher and everything else to go lower. I mean, it is that simple of a discussion. If we drill down into smaller time frames, 5, 10, 15, 60-minute charts, any kind of Renko, or however you want to break these up into some sort of tick or pip-based charts, I mean, the answer is for now, the path of least resistance is up with the U.S. dollar and down with everything else. So let's take a look at closely. The DXY, switching out to Trading View. Make the screen a little bit bigger here. So this is kind of what we saw. If we look at all time here, and notice they brought some more data in, by the way, to Trading View. So they have data going all the way back now, whereas they just had it to about 1996. So we can actually go all the way back now and see the absolute craziness of the 80s. I mean, the early part of these, look at this. I mean, so, for those saying, well, we can't make these crazy moves, it's not going to continue. Irrationality can continue a lot more than you can remain solid, right? Two of the best pieces of risk management advice I've ever been given, okay? Don't forget them. We had a move from 84 in 1980, it's right around the election of Ronald Reagan, just an absolute rip in the U.S. dollar. I mean, this thing basically doubled. I mean, how crazy is that? In the course of 5 years. And then just absolutely got murderized back down to an equilibrium, which, is somewhere in this 110 area, at least over long periods of historical perspective. But let's just reflect on the fact that can happen. Doesn't mean it's going to now. In no way am I talking about a 160 target on the high. I only care about of recent highs, right? And here's the expanded chart of recent highs. And let's move this back into perspective. Okay, so here we go. So now I think you probably have, if you hadn't before, you're understanding why I think 120 is probably not a stretch. When, how long, for what period of time, I don't know. I would say don't fight the Fed, right? Down to a daily, since we seem to be like super time framing a way out. So I actually disagree with this red line. I would probably carry this all the way out. So I'd imagine this 109 area is going to be somewhat of a floor and a decent sized pullback. Just know that at least from a daily chart perspective, we're riding these upper Bollinger Bands. Okay. If you hadn't seen these settings for this indicator, here it is. These are custom settings. So don't even get me started on why the 34 EMA. There's an entire 2-hour session I could shoot just on that. But in any case, so that's kind of the level where we are. I'd expect us to take a look at the euro. Obviously, this is the opposite. So of note, I'm going to get too much into this. Polar opposite of what we just looked at, right? This 0.993, well, yeah, I mean, they're about 70 pips under a buck here. So essentially just this 99.30-ish area, support. We can get over that. I think we will probably travel somewhere up near the middle of this. When, how long? This could certainly come on, Wednesday, Thursday, Friday if the right context comes out of anybody from the ECB, right? Or the Federal Reserve's discussions. Although I think that if you're looking for any earth-shattering, landsliding type movement, I think most of it's already taken place. So I think we're probably at a little bit of less risk, at least for the next 3 or 4 days. I think it'd be okay to trade during that period. But, I always joke, what if Stevie's being proved wrong, right? And you want to focus on something that I am not talking about. So the weakness of the pound, and by the way, it was the first time ever here's a great example of the currency conversions. I bought it was about a $90, it was $90 piece of software. It's just some custom coding I'm getting done for one of the computers in one of my cars from somebody that's an expert in the UK. And I paid $90 for it in pounds, and it came out to $103 US in the conversions from, my Visa credit card account. So that's like one of the best I've had in like a long time. So those of you that are hunting for quality deals in the UK landscape, of which there's many, especially in classic car land, just know that's sort of like real world stuff that you're seeing done, US CAD just still not broken out of any significance to the upside. I mean, here's that yen. Again, you gotta literally go all the way back to, we're on monthlies here. I think they brought some new data in. Let's check it out. So here's monthly, all the way back. Let's reset the scale. Yeah, so here you go. So I would imagine we'd be gunning for this 147 area if you trade the yen at all. This would be the target. I'd imagine we sell out and sort of trade sideways here, but ever since this breakout, this has been one of the, keep in mind, these are monthly charts, guys. Each candle represents a single month, not a day. These are just massive moves, right? Just goes to show you how dislocated most of this planet, especially in developed markets, has become because of all the disruptions in everything. It's crazy. Also, US dollar still within. CAD franc, CAD JPY. Again, weakness in yen, no surprise. It's going to correlate perfectly there. Euro JP. Here's Euro CAD. Notice this breakdown underneath. This 135.38-ish area. Pretty solid resistance at this point. Euro GBP still in this tight window. Well, they've both been really weak. Yes, but in relation to each other, they've been equally weak. So that means you're going to be building a sideways chart, right? Let's take a look at GBP CAD. Now, keep in mind these are monthly charts we're looking at, right? So if let's drive this one back to a daily, do a reset. This is a solid line of support, this 1.53 area. But this will be resistance 1.53 resistance on the way back up. If your break of this area of support was the start of your, actually I disagree with that, it's kind of sloppy. Yeah, I'm not even going to show you guys that all. I don't want to confuse anybody. Thought I saw a decent slingshot opportunity, but I was wrong. Alright, so let's take a look at spot gold again, just talking about this. Last high was March of 22. Since then we've had a 15% sell-off, right? Actually a little more. When we should be rallying. Oil. Sitting in a big. So if you're going to see any rallies in oil, right? And with all the wrangling, if you will, and bell whistling at the top and everything in Europe that, hey, you know, Russia's just going to cut us off. By the way, for those of you that are listening to this cast anywhere in Europe, if you are a resident, we at Auvoria feel for you. Our condolence is essentially for your energy bills. But if there is one thing you guys can take away from this that hopefully will come to the top of your list, and it already is, because I mean there's riots, but if there's ever been a time to call your policymakers, right? This country, that'd be your House of Representatives folks in your district, or your senators, or any of your representatives in whatever body of whatever house in Europe, right? And say, this is one of the most beautiful historical examples of a lack of energy independence. It's killing us, right? And this is a great example of what, you know, having energy independence can do, not this particular chart, but just the fact that somebody else has gotten you guys by the stranglehold is sad. And, you know, our hearts here, we was actually talking to one of the owners of Auvoria, Bill Wynn, and she's the main owner of Auvoria, and he basically, he said that, you know, obviously people there, we have a fairly large subscriber base in Europe, and, you know, we just want to see more growth out of it. So, you know, basically the team's taken off, and they're on road shows in the UK, if you guys didn't know, stuff like that. And, you know, our new president has said, you know, looking at, you know, what's going on over there, it's just tough for the everyday common person to sort of get, you know, their arms around doing anything else other than paying their energy rails, right? So that's my long path of my pointless discussion here is, you know, just get out and complain about it. That's all I'm going to say. Anyway, back to energy, or I should say the lack thereof, in terms of quality pricing structure. Let's take a look at the bit now. One thing of note here is this. Where are you right here? We're on the edge. Look at that. right there, we're the edge. We've made 1, 2, 3, 4, probably about 11 attempts at this level when it's rallied every time off. There's no way that I would be stepping in front of this and buying right here. This is and could be, keep in mind this is a daily candle, but right around this area could be an absolutely protracted move, just like you saw here. There are a lot of bag holders here, right? So my advice to you guys with your potential laser eyes, don't be a hero here. Let these things fall. In this case, it could be a precipitous one. Take a lot. Look at all the missing notches, by the way, in this profile. Actually, if you look at this over the whole period of time, let me just reset this. Let's look at the whole profile here. Look at all the missing notches down here. Well, what are missing notches, Steve? It means that there's basically no volume down here. It's like no man's land, right? I call it a zipper, right? Zipper is mostly related to a move that's protracted. But anytime you have an area where there's no volume, obviously things could turn around and go back up because there was no volume and there's nobody down there to buy, right? Which means it could go forward. But it could also be institutions defending this level, and then if they do step out of the way, other time frame players, right, and they finally give up the ghost, we're going to zip right through this. So I would say let it play out. If you want to be a buyer of the coinage, as I've been saying for damn near a year, I'd rather be a buyer down at that $4,000 to $12,000 level. We may actually see that. So just stay tuned on this. Don't be a hero. If you're looking to short this area and you can find a good borrow, and it starts to break, go for it. Or some sort of inverse ETF. I don't pay enough attention to this space. So, in any case, I think that's pretty much everything I wanted to say today. So we got news. Let me just go through Twitter real quick. If you guys didn't know, I have the propensity to retweet stuff I think is quality information related to risk management, trading, and portfolio management, right? So it's for the big reason I follow about 237 people, in which I'd say maybe about 40% of them are really, really good at what they do. And in many cases, they're billionaires and of the like, or very wealthy portfolio managers that, sometimes maybe talking their book, but they're offering pretty solid advice. In a lot of cases, it's totally unbiased. So I think I did want to point you guys towards, as if this is maybe more for an equity land, as everybody should know. It is, in my opinion, if one is going to build a portfolio for themselves of cryptocurrencies, at some point, especially if you do well, you're going to want to diversify that portfolio out into other areas of investment, right? So maybe real estate works for you, albeit carefully. You're probably going to see some big declines coming up. But outside of that, if you want to invest in equities, the best way to do that is to understand how to analyze them, right? So Brian Feroldi here actually put a really good piece on the balance sheet is one of three major financial statements, and essentially, it breaks down assets, liabilities, and shareholders' equity, and there's a whole thread he goes into. It's actually really good. This is like core balance sheet class stuff, right? So accounting classes are boring, but honestly, I really think that not everybody needs to understand necessarily accounting portions, but you certainly do need to understand the difference between a debit and a credit, right? If they're crediting your account, they're putting money in it, right? Their debiting account, they're pulling it out, or whatever, right? Debit card. Just think about that, right? But it's just amazing to me, people just don't get this. And people that have made it through business schools that just don't understand the basic concepts of macro versus microeconomics, right? Talking to my kids about this a lot, they think I'm a broken record. But my kids are never, ever not going to understand when they walk into their first dealership, buy a car, buy a house. More than likely, they'll be dragging me with them. But let's say I'm dead, hopefully I've done a good enough job to teach them of the core understanding of money, right? How it works and how it flows and how it can be manipulated and how you got to keep close watch on it and don't trust it to others, right? All the core risk management stuff you're going to try and instill on your kids. I still think it comes from learning the basic cores of this stuff, which I'm basically demanding that my kids learn in both cases. I don't care if they fight me on it, they will learn this. And they will thank me for it down the road when they're not getting completely screwed over and they have some sense of a semblance of risk management. And that will be my theme for the week. Teach your kids money, if you have any. If you have some down the road, teach them money there. My name is Steve Vetterl. Today, 9-6 off the mic.